Hey everyone, it's Monday morning, March 10th, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella. Since it's Monday, that means it's time to dive into the big market movers for the week ahead. It's going to be a busy one, so let's get straight to it. Before we begin, a quick note. Today's episode is sponsored by AMF Capital Asset Management Frankfurt. For tailored investment solutions and top-quality mutual funds, visit amf-capital.de. So here we go, another week ahead in the markets, and it's a big one. Last week, stocks took a hit as investors struggled to make sense of President Trump's tariff plans and their potential impact on the economy. The S&P 500 dropped more than 3%, the Dow lost over 2%, around 1,000 points, and the Nasdaq Composite fell nearly 3.5%, now officially in correction territory, down more than 10% from its last record high in December. Now, investors are looking ahead to key inflation data this week, hoping for clues on how tariffs might influence prices in the months to come. The Consumer Price Index and Producer Price Index will be in focus, along with updates on inflation expectations and consumer sentiment. And on the corporate side, it's a quieter week for earnings, with Oracle and Adobe standing out as the main reports to watch. So, what's the Federal Reserve thinking? Well, Friday's job report showed the economy added 151,000 jobs in February, just below expectations, while the unemployment rate ticked up to 4.1%. Economists took it as a sign of a softening but still stable job market. And while markets continue to price in 3 rate cuts for 2025, the big question remains, when will the Fed actually start cutting again? On Friday, Fed Chair Jerome Powell made it clear, there's no rush. In his words, we do not need to be in a hurry and are well positioned to wait for greater clarity. With the Fed now in its blackout period ahead of the March meeting, we won't be hearing from policymakers this week, but markets will be watching the data closely. And that brings us to Wednesday's inflation report. Wall Street expects headline CPI to come in at 2.9%, down slightly from 3% in January. Monthly price increases are expected to be around 0.3%, lower than January's 0.5% rise. Core CPI, which strips out food and energy prices, is forecast at 3.2%, also down from 3.3%. But here's the key thing. Many economists believe this report will only provide an initial taste of the inflationary impact of tariffs, with a bigger effect showing up later in the spring. Now let's talk about the broader economic picture. The recent sell-off in stocks has been fueled by concerns about weaker than expected growth and the potential drag from tariffs. Several major banks, including Morgan Stanley, JP Morgan, and Goldman Sachs, have all downgraded their GDP forecasts for either the first quarter or the entire year. But here's the interesting part. None of them are actually calling for a recession. Goldman, for example, only raised its probability of a recession in the next 12 months to 20% from 15%. And corporate America doesn't seem too worried either. FactSet data shows that only 13 companies even mentioned the word recession in their S&P 500 earnings calls this quarter, the lowest number since 2018. So, what does that mean? Well, it looks like markets are just recalibrating their expectations after a year of strong growth. As former White House economic advisor Jason Furman put it, the economy isn't turning on a dime, but uncertainty and sentiment are pushing toward slowing. That's the setup for the week ahead. We've got key inflation data, tariff worries, and markets still trying to figure out where the economy is really heading. Stay tuned and don't miss the next Capital Markets Quickie.